After 5 months of gut-wrenching volatility, for the first time since February, the S&P 500 finally closed above the 2,800 level, and stocks had every reason not to rally today. The banks were selling off after earnings. The AT&T Time Warner deal has another hurdle to face. There's worries over the NATO skirmish and even the escalating Russian probe. All that didn't weigh on stocks. So was this move, albeit small, the start of a bigger bullish breakout? And is it a sign this market is heading back to record highs? Guy.
Well, Wednesday when I got back, I thought the move would be down. I thought it would go back down to sort of 2680, test those level and sort of fluctuate in this range. Steve said actually the move would be higher, and here we are back to 2800. So I have to sort of say Steve was spot on this one. I didn't see it coming. These bank earnings I thought were really good. Thought the market should have rallied, but banks continued. They can't get out of their own way. The broader market, though, wants to go higher. 2872, I think it's the all-time high. Feels as though it wants to take a shot. Doesn't make sense to me, and everything you mentioned should take us lower, but you really can't fight the tape at this point.
We didn't even have technology participate sector-wise, right? Technology was down, too. It was industrials that led the sector higher.
It was industrials. You had staples, which aren't big enough to really do anything. It just seemed like it was everything but technology doing it. I would have thought that financials would have contributed something today. I do think we're going higher. I do think we're taking out old highs. There's some baby steps of resistance, but that 2,800 was such a big level. I think that's the springboard.
Well, also did it without the small caps, too, right? So staples going up, small caps going down. To me, that does not actually make for a very bullish type of breakout. I would not be surprised to see this thing fail on Monday. It did not feel like euphoria and the entire market was participating today. And by the end of the day, we saw that.
Well, the things that concern me are the bond market. And unfortunately, we have Fed Powell. I think it's very important. We have the Humphrey Hawkins, which is a semi-annual testimony in front of the Senate next, I think it's Tuesday. And ultimately, I think you've got a dynamic here where if the Fed actually tells you they're a little concerned about trade, whatever is going on the trade front, that is something that I think will continue to flatten the yield curve. And I think the yield curve, I care about it so much less for banks than I do for the broader economy in the sense of what we've got. But I actually think the price action is fantastic, especially given the week we had.
Don't you think that's more bullish, though, if they say they're concerned with trade? Because that's the angle I come at it with, that they'll slow down a little bit on their raising of rates.
So you're going down the as bad news is good news, less is more. I think for the first couple kind of shots across the bow on that, it's good news for a market that wants less Fed. But ultimately, I think this market is very concerned, and the yield curve is what's showing you that. I think that's concerned about growth.
More concerned about the Fed and what they might do, or trade?
That's been my concern all along. It's been the Federal Reserve.
The Fed is bigger than trade.
When Powell took over that one day, it's funny. Brian Sullivan talked about every market tests the new Fed chair coming in. The market will test, and he was right about that. And I think he's still being tested. But with that said, the speed with which the yield curve's going down to 26, 27 basis points is astonishing. I know if Tony Dwyer were here, he'd say you have 12 to 18 months of a still run to the upside. And that's what history has said. But this is, to me, it's a different time in history. I'm not certain that you have that kind of runway. And I don't think we've ever seen this yield curve flatten to the degree that it's doing so now. It appears as though it wants to flatten out, I would say, by Labor Day. That was Tim's phone, by the way, in case you folks
Everybody's phones are off today?
My phone's off.
Yeah, mine is.
First time on TV, folks. What can I tell you? I don't know how that happened.
I don't like the fact that when they talk about the yield curve, and this is the Fed, and this is everyone that you see on television is saying that it's different this time. I don't think it's different this time. I think an inverted yield curve is an inverted yield curve. But I do believe the same thing that Tony Dwyer believes. I believe that you have some time to react to that inverted yield curve. And I think everyone is so afraid of it that it's lost its power, it's lost its steam as far as a headwind. So we're seeing a lot of these headwinds become tailwinds because we've become a little bit numb to it.
Yeah, I don't know. I mean, everybody I talk to seems to be very concerned about the yield curve. And I actually think it's one side of the trade and the yield curve are two sides of the same coin, right? So we had this big $200 billion list that came out there. There was some very serious technical damage to a lot of commodities markets, the U.S. dollar. All of these things could contribute to a slowing economy, and I believe that's what the market is telling us here. So if I look out and say, hey, you know what, 2019, what it's going to look, we're now in July, what are earnings going to look like? Do I have to factor in a slowing economy in my earnings estimates for 2019? I think the answer is yes, based on what the markets are doing today.
And should we be worried about the consumer at this point? And we got CPI data, right, which showed a jump in June, but basically wiped out all of the wage growth that we've seen so far this year.
They're offsetting each other.
And we haven't even seen the full effect of any tariffs go into play. So we haven't seen the full inflationary impact that it might have.
Well, again, so the first $50 billion were selectively chosen to be industries where they're probably not going to go too hard against the consumer. This $200 billion, the first $50 billion, you could have some major nonlinear supply chain disruption, which will go straight to the consumer. I think there's products in there that we can't really easily replace in this country. So I am worried about inflation. I think prices are going significantly higher, and I don't think equities are pricing that in.
And quickly, consumer debt to GDP is north of now 50%. That is a staggering number. It's probably at levels we haven't seen in a decade or so. So am I concerned about the consumer? Never underestimate the U.S. consumers want to spend doesn't mean they should be spending. And the flip side of that coin is corporate debt to GDP is now about 46%, which is at a ridiculous level as well. So at a certain point, and even Tony Dwyer, if he were there, and he's watching now, no doubt, would say, you're right, it's going to end horribly. My only point is I think it does a lot quicker than people think.
To your point. Yeah. So what banks will do right now is they'll make a whole bunch of really junky loans. That's going to be the next 6 to 12 months because they don't have those NIMs necessarily to do anymore. So they're going to try to do more loans and get volume rather than get quality. And that happens every cycle. This is not unusual.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.